Hello friends, welcome to the unit number 11 theory portion of our ABFM, and the chapter name is, you can see, is adjustment of risk and uncertainty in capital budgeting decision. So last two chapter we have discussed in detail about this capital budgeting, right? In the first chapter number 9, we have seen what capital budgeting was all about, and in the second chapter, that is chapter number 10, we have seen that how capital budgeting is helpful in international financing. Now let's see how we adjust the risk and what are the uncertainties in capital budgeting decision. So basically these are the topic which we will study. The first is objective, introduction, what are the sources and perspective on risk, sensitivity analysis, scenario analysis, Hilliard's model, simulation analysis, decision tree analysis, corporate risk analysis, right? So we will cover this particular chapter in 2 to 3 videos most probably. So let's get started with the first one, that is our introduction. So I hope everything is clearly visible to you, right? So see, let's talk about this introduction. So friends, we are diving into capital budgeting, one of the most crucial topic in financial decision making. So imagine you are running a business and planning to expand, maybe setting up a new factory, maybe launching a product, or even investing in new project. So what you are doing, basically you are running a business and you are planning to expand. So here the keyword is expansion, right? You are planning to expand, right? So now before you put your hard earned money into it, you want to check how much it is cost. So obviously you will want to check the cost, right? Obviously you will want to check how much you will earn, you will want to check your earning, and also whether it is worth the risk, this is also you will check, right? So that is exactly what capital budgeting helps with. It is like planning your expense and earning before making financial commitment, right? So basically what you are doing in capital budgeting, you are planning what you are doing. You are planning planning your expense, right? Planning your expense, planning your earning, right? Before making big financial commitment. I hope it is clear now. So what goes into capital budgeting, right? So you can see, required for project implementation often take a long time, estimating future cost and revenue for new project of an ongoing enterprise. That is what I told you. Cost, how much you will earn, is it worth the risk, right? Is the cost worth the risk? So these things you must forecast it. This is what we call capital budgeting. Now the second pertinent question is to us is, what goes into capital budgeting? Let's answer this question. Let me write down what goes into capital budgeting. In short, we call it CB. CB stands for capital budgeting. So friends, you know that when estimating project cost, we consider buying land, we consider setting up machinery, we consider hiring worker, we consider buying raw material, and also we consider managing day-to-day expenses, which we call working capital. So these are things we consider, whether land is to be bought, plant, setting up machinery, whether we have to set the machinery, hiring workers, buying raw materials, and managing day-to-day expense, which we call working capital. But wait, predicting revenue is not that simple, right? So if we want to estimate the revenue, right, predict the revenue, it is not that simple, right? Because market are unpredictable. So let me take you to the next slide. So I hope so our answer is clear, that what goes into capital budgeting. So we consider all these factors, but predicting revenue is not that simple. That is what it is written, complexity, revenue estimation complexity. Because why revenue estimation is not simple? The reason is that market is unpredictable, right? Some competition, customer demand, economic condition all plays a role, right? Competition, customer demand, right, and economic condition all plays key role, making revenue estimation a challenging task. So that is the complexity associated with the revenue estimation. Now the risk factor here comes into play. So every investment comes with the risk. So investment is there, so it means the risk will also be there. So investment comes with a risk. Some risks are within the project itself, right? Some risks are within the project. Let me give you some example, like like unexpected cost overrun or sales fluctuation, right? So suppose unexpected cost overrun, let me write down. So I'm writing the risk. So unexpected cost overrun, this is one kind of risk. Other kind of risk can be sales fluctuation. Sales may fluctuate, right? So this is an standalone risk. Other depends on some external factor, like industry trend, market crash, or change in the government policy, right? So that is our industry trend. So these are called, you can see the types of risk is written here. Just now I'm taking you that every investment comes with a risk. You can see two types of risk in your book. The first risk is the standalone risk, other is the contextual risk. So a standalone risk means what? Some risks are within the project itself. So these type of risks are within the project, right? Like unexpected cost overrun, right? And sales fluctuation, these are called a standalone risk. And other depends on some external factor, like so these are called contextual risks, which depends on external factor like industry trend, like corporate market crashes or change in the government policy. Suppose government policy get changed, right? So this is called contextual risk. So basically two types of risk are there, a standalone risk and contextual risk, right? So a standalone risk, just now we have talked about that some risks are within the project, so these risks are within the project, and contextual risk outside the project, right? So depends on some external factor like industry trend, market crash, or change in the government policy. And if you are investing in another country, right, if you are investing in other country, so there is another kind of risk, right? The risk got even trickier, that is different law, different currency fluctuations are there, political factor there, so that is called cross country investment. So this add the risk, this multiply the risk. So obviously these two risks are always there, standalone risk and contextual risk. A standalone risk stand for within the within inside risk, right? So within the project risk, and a contextual risk means external factor like market risk, corporate risk, government policy risk, right? These are called contextual risk. So friends, these are the two kinds of risk that is exposed to. These are the risk factor. Obviously every investment has a risk. Still some risks are within the project itself and some risks are outside the project, and that is how we have categorized these two. I hope this makes sense to you. Now the question is why we need for risk analysis, why risk analysis is crucial. Let's answer this question. What is the need for this so-called risk analysis? Risk is the trickiest part of capital budgeting. So we are dealing with capital budgeting, right? And for capital budgeting, risk is the trickiest part. One wrong calculation and your entire project could go off track. That is why financial experts spend so much time analyzing risk before making big investment decision. So that is why risk analysis is super important. Before you make any big decision, you should do proper risk analysis. So in simple words, let's talk about whatever we have talked about. Let's summarize. We have discussed that capital budgeting is like planning a road trip. You check your budget, you estimate fuel cost, you plan routes, and prepare for uncertainty like bad weather or roadblock. The better your planning, the smoother the journey. That's it, right? So we have answered some questions to the point which we have discussed just now. Let me remind you what question we have answered. First question we have answered that what is capital budgeting and why does it matter? So the answer was that capital budgeting, how much it will cost, how much you will earn, whether it is worth the risk. That is exactly what capital budgeting helps with. It's like planning your expense and earning. Second question, I told you what goes into capital budgeting. I told you that land, machinery, high worker, then raw material, all these things goes into capital budgeting. Then we also talked about the risk factor, right? So what kind of risk are they exposed to, and what happens when a foreign country comes into picture, that we are dealing with our counterparty is foreign country, that we are doing cross country investment. So we have talked about some more type of risk which add into our journey besides this standalone and contextual risk, and why we need the risk analysis. I hope this makes sense to you, especially in the context of capital budgeting. Now let's jump to our next topic, which is the sources and perspective on risk. Very, very important. So friends, in our last slide we talked about capital budgeting and why risk analysis is so important. So in this slide we are going one step further. Let's explore the different type of risk that business face when making big investment decision. And get ready, this is going to be eye-opening. So the first kind of risk is called project specific risk, which is also called when the project itself is risky. So imagine a company investing in a high-tech project. So there is a company which is investing in a high technology project, right? Setting up factories in politically unstable country or dealing with hazardous chemical. You see, hazardous chemical, unstable country, high technology, right? So these projects are full of uncertainty. Obviously, high technology are there, unstable countries are there, hazardous and polluting chemical are there. So obviously they are full of instability, right? Unstable. So or we call it uncertainty. So one sudden political change, a safety hazard, or chemical mishap, and the entire investment could be at risk. That is why company think twice before getting into such project. right? So which kind of project I am talking about? So suppose some project that deals in politically unstable country, or deals with the hazardous chemical, or deals with the high tech project. So obviously these projects are full of uncertainty. Uncertainty is quite high there. So this is called project specific risk, because these kinds of project have a specific kind of risk has been involved in it. So company think twice before investing in such project, or before getting into such project. Then the second kind we have is the demand versus competition. So let me write down demand versus competition. What it means, what I mean to say, this is called a double-edged sword, right? This is called what, this is called double-edged sword. What is the meaning of this double-edged sword? You'd think that if demand for a product is high, business would be booming, right? Suppose the demand for a product is high, so business would be booming, right? Well, not always. More demand attract more competitor, making it tougher to maintain sales and profit. So if you think that demand is high, it means what would the product be booming? Suppose if a demand for product is high, so the business would be booming, right? But not always that. It happens, but not always. Why? Because if demand is higher, let me write it down. If demand is higher, it means what? It means competitor are more. Competitor will be more, right? And competitor will be more. It make it tough to maintain sales and profit. Obviously, since large amount of competitor are there, so sales and profit will be tough to maintain, right? So for example, take a smartphone for example. Whenever one company launch a successful model, dozen of competitor jumps in, creating cutthroat competition. So this is called immense competition. So that is called demand versus competition, double-edged sword. Why? Because most people think that if demand increases, company would be booming, her business would be moving. No, competitor also rise, and this create a cutthroat competition. So this is another thing. Then we have seasonal and policy risk. So here you will know that timing is everything, right? Timing is everything. So what do you mean by that? You see, let me explain to you. So friends, some business like tourism, agriculture, festive sale depend heavily on season. Obviously, so some business name I am telling you, that tourism, agriculture, festive sale, they depend heavily on season. A bad monsoon can ruin farming profit, just like a sudden government policy change can impact the entire industry overnight. So think of how a new tax rule, right, can shake up the entire profit, right? So this is what I'm telling you. Some business like tourism, agriculture, festive sale heavily depend on season. So let me write it down. Some season based industry. Just now I've told you tourism. This is one business. This again business I talked about agriculture, and the festive sale. So these heavily depend on the season. A bad monsoon can ruin farming profit, just like a sudden government policy change can impact the entire industry overnight. So think of how a new tax rule can shake up the stock market, right? So this is called policy dependent business, right? So that this is another thing that matters. Another thing is marketing risk, which means expanding from local to global. So when I talk about marketing risk, simply means that we are currently local and we are moving global. This is called marketing risk. So selling a product in your hometown is easy, but expanding to international market, what do you think? That's a whole new ball game. Different culture, customer habit, advertising strategy make marketing a challenge. So a product loved in India might not work in the US and vice versa. Company needs solid marketing strategy to succeed globally, right? So that is what it's telling here. Expanding from local to international market poses significant marketing challenges. So these are the kinds of risk, right? Project specific risk, demand driven competition, then season varies, season based policy, and marketing risk. Then we have international arena risk. So okay, we have talked about it. Exchange risk. Let's talk about this so-called exchange risk. What do you mean? That currency fluctuation can make and break a business. So suppose you are dealing with the international trade. So suppose you are dealing with the international trade, right? So dealing international trade, so the value of currency can impact your profit. Let's say an Indian company export good to US. So suppose this is an Indian company and it export goods to US. Fine. So if the Indian rupees weaken against the dollar, so suppose rupee become weak against the dollar. So what happened? They will earn more profit. Because Indian rupees is weak, so more profit will earn, because this company I'm talking what perspective of this company which is investing in US, right? So if you are dealing in international trade, the value of currency can impact your profit. Like in this case, Indian company export goods to the US, so they are exporting, so they will receive amount in dollar, and rupees is weakened, so they will receive more rupees. That's why they are in profit. So they will earn more profit, right? But if the rupee is strengthened, if suppose rupee is strengthened, what will happen? So their earning will shrink. So that is why business keep a close watch on the forex market. So that is why, you know, currency exchange fluctuation impact international business. So business keep a close eye on this exchange rate or forex market. Then we have something called regulatory scrutiny and regulatory environmental risk, which is a hidden cost. So suppose if the company is setting up a hazardous plant, so if the company is setting up a hazardous plant, it faces intense government scrutiny. Pollution laws are strict, and if the company if the company don't comply, it could face fine or even shutdown. Plus, setting up pollution control measure cost a fortune. So not planning for these risks can lead to major financial loss. Obviously, because, you know, you are setting a hazardous plant, so they are monitored closely by the government, right? And they have to pay fine if they violate any kind of rule. Then we have something called pollution control. We have talked about it. Now let's talk about the corporate fight and takeover bids. So sometimes what happen? So basically this is boardroom battle which affect the business. Sometimes what happen, that company face internal conflict, right? So basically here it is talking about so-called internal conflict. You know about this internal conflict? Let me give you some example. So for example, you know, shareholder fight may be there, or let's say a takeover may be there, or let's say that some future retail is there. For example, you know, take Indigo airline or future retail. So dispute at the top level of the management affected their entire business performance. So these risks may not be directly related to the operation, but they can still shake investor confidence, right? Obviously these risks are not related to the operation, but they can still shake the investor confidence. So you know what we learned from this discussion, that every big business decision comes with risk. Some can be controlled while others are unpredictable. So a smart company analyze these risks before making any investment. Just like you should analyze CAIIB exam strategy before jumping in. Obviously you are jumping into CAIIB exam, so you must analyze the CAIIB strategy, right? So similarly business must think about this kind of risk that can happen, that can be started, right? So some risk can be controlled, some cannot be controlled, right? Other are unpredictable. So smart company analyze these risks before making investment. I hope that makes sense to you. So that is our 1.2 topic what we have discussed just now. What we have discussed in this topic, that are sources and perspective on risk. Now let's jump to the topic number 3, that is our sensitivity analysis. Super important topic. Let's go through it. Let's discuss what this sensitivity analysis is all about. So friends, now from here mathematical parts comes into the picture. So friends, in this slide we are diving into sensitivity analysis, a powerful tool in capital budgeting that help business prepare for uncertainty. Sounds complicated? Don't worry. So I will break it down with a super relatable example. So the first question is obviously what, that why this sensitivity analysis? Why do we need this analysis? So imagine you are starting a business. Let's say you have started a PET tube manufacturing business. Let's say you have started a PET tube manufacturing business. So you plan all your cost, expected sale and profit. You plan your cost, you plan your sale, and you also plan your profit. But wait, the real world is not that predictable. You know, the real world is not that predictable, right? Price of raw material might increase, taxes may change, competition might lower your expected sale. So if we don't prepare for these uncertainty, our business could be in trouble. That is where sensitivity analysis comes into the picture. So I hope I have answered your question, why this sensitivity analysis? Because just now I have given you example. You have started a PET tube manufacturing business. You have predicted your you plan out your cost, sales and profit. But wait, the world is not that predictable. Price of raw material might increase. Obviously raw material price can increase, right? Tax may change, or competition might lower your expected sale. Competition is there, high competition is there, and it may lower your expected sales. Obviously your sales will become lower. So if we don't prepare for this uncertainty, our business could be in trouble, and that is where sensitivity analysis comes into the picture. So before we move forward, let's talk about the key components. Let's talk about the key components of capital budgeting. So you know that before we talk about sensitivity analysis, let's look at the basic number in our example project, right? So let me show you one example so that it become made very clear where it is. Just wait a minute, let me see. Yes, here it is. So here you can see PET tube manufacturing, right? So your investment, which is the initial cost, is 40,000 rupees. Suppose it is rupees. Your sales revenue per year is 36,000, right? And your variable cost is 24,000, and your variable cost, 24,000. Variable cost means what? That, like, suppose material cost is there, suppose labor cost is there. These are the variable cost. And your fixed cost, you know, is how much? Factory, rent, utilities. So this is 2000. Okay, now so basically these are the cost incurred. So this is what is written, that vital component of the capital budget include cost, revenue, net profit, right? So here you can see variable cost is there, fixed cost is there, and depreciation is given at the rate 10% of the project cost, right? So can you tell me what is the 10% of the project cost? The project cost is 40,000 you have invested. What is the 10%? So it is nothing but 4,000. So depreciation is how much? 4,000, right? At the 10% project cost. So now we know the sales, variable cost, fixed cost, depreciation. So can you tell me what is the profit before tax? So whenever I say that, I will prepare a particular this is diagram. Always remember this. So this is 36k, right? And one portion of the variable cost it is, which is 24k. So rest portion is how much? 12k. Out of 12k, some portion goes to our fixed cost. So fixed cost is how much? 2k, right? Then how much is left? So 12k minus 10k is left. So 10,000 out of 10,000, depreciation cost some. So 6,000 is left. So this is our 6k. So this 6k is our profit before tax. And now tax is given at the rate 33.33%. So what is which is almost, you say, 1/3. What is 1/3 of 6,000? It is 2,000. So after paying the tax, profit after tax is 4,000, right? So this is the data. I hope this makes sense to you. We have already covered it so far, right? We have to subtract the depreciation and we further add the depreciation back, and now we have to see what is the cash flow from operation. So depreciation, why we add it back? Because you know it very well that depreciation is a kind of non-cash expense, that's why. And profit after tax is 4,000. So and cash flow from operation is how much? 8,000, right? From your operation, the cash flow which is generated is 8,000. So net cash flow is 40,000 and 8,000. So now this looks like a solid business plan, right? But what if something changed? What if the raw material cost increased by 10%? Obviously it can be possible, right? What if the sales drop by 10%? Now the question is how this sensitivity analysis help. So this thing we already know. So the now question is, we know how this sensitivity analysis help in this case. Let's discuss. So sensitivity analysis check how sensitive our project is to the change in key factor. So let's say we are tweaking one element at a time, means we are changing one element at a time. Let's say we are changing the cost, let's say we are changing the sales, or let's say we are changing the tax. So by changing one element at a time, that is cost, sale or tax, we can predict what will happen to our profit. Think of it like a what if machine, right? Think of it, you can think of it like a what if machine. So what if machine, what if the sales drop? Profit will decrease. What if the cost increase? Profit will shrink. What if the tax rise? Less money in hand. So this method help business prepare for worst case and best case scenario. So this is called a what if scenario, what if machine. What will happen if our profit shrink, right? So that is called a what if machine. I think this makes sense to you. So this method help prepare for worst case and best case scenario. Here you can see best case and worst case scenario, right? It's like checking different weather forecast before planning an outdoor event, right? So why it is important for your CAIIB examination. So bank and investor love business that plan ahead. If the company know how change in the market condition affected profit, it become a safer bet for funding. That is why understanding sensitivity analysis is crucial, not just for exam but for real world decision making, right? I hope this makes sense to you, right? So now let's continue our discussion. Just wait a minute. Okay, now let's come back to here with a total investment of 40 lakh. So let's see how it have effect. So friends, at the project overview, what we are looking at. So a company which has invested 40 lakh, actually it was 40,000 crore, right? This data is in crore, right? 40,000 crore in a big project. 40,000, I think here it is a lakh. Okay, no, doesn't matter. Let's take lakh only. So 40,000 lakh in a big project. They expect to generate a sales of how much? 36 lakh, right? So they are expecting a sales of how much? 36 lakh. I think that was the same. Okay, yes, 36 lakh sales they are expecting, right? And after all expense and tax, they made a PAT of how much? PAT is 4,000, right? Crore lakh. Sound great, right? But here is the best part. After accounting for all cash inflow and outflow, the net cash flow from the operation comes out to be 8,000 lakh, right? So is it worth it? So the question is the project worth it? So obviously the question, so cash flow from the operation is how much? 8,000 crore or 8,000 lakh, whatever it is. So now before deciding if this investment is a gold mine or at risk, we need to look at it NPV. right? We need to look at the NPV. What is NPV? NPV, you know, it net present value. In the last two chapter we have discussed it in detail. So NPV stands for net present value. It checks us whether a project is worth investing by considering the time value of money. You know, a rupee today is more valuable than a rupee 10 years later. So we adjust future cash flow using a discounting rate. In this case, what is our discounting rate? A discounting rate is 12%. In this case, the discounting rate is 12%. So we adjust it, right? So the result NPV comes out to be, you know, how much? 5200 lakh, right? 5200 lakh, which means in a normal scenario the project is looking pretty profitable. Why? Because net present value is 5200 lakh, right? And I tell you that you have to compare it with the PAT, profit, right, which is 4000. Obviously this look a great thing, but what about the risk and uncertainty? Hold on, what if the something change, right? So looking at the NPV, it look good, right? So net cash flow, how it become 8000? Why it become 8000? Because we have added the depreciation. I told you earlier, right? After calculating the PAT, which is the cash, which is our, you know, cash, also you have to add the depreciation. Depreciation was how much? 4000. So this become 8000. So now it is clear why cash flow from operation is 8000, right? I hope this makes sense to you. So this is 8000, and our net present value of this it comes out to be 5200 lakh, right? 5200 lakh, right? So based on this, what we can see that this is profitable business, and project term you can see is 10 year. NPV is coming 5200 lakh, right? So but here, you know, what about the risk and uncertainty? So what if the something change? What if the sales drop? What if the raw material cost increase? What if the fixed expense go up? To understand how this factor impact the project, we create best case and worst case scenario, right? So to understand that how this factor, what are the factor, like sale, raw material cost can change, fixed expense can go up. So how can this factor impact the project? We create best case and worst case scenario. This means we change one variable at a time, keeping the rest constant, to see how it affect the final profit and cash flow. Think of it like, you know, crash test for a car. You know about this crash test for a car? You think about like this. So we test different situations to see how strong the project really is. So I hope this makes sense to you. So final takeaway is that NPV tells us whether investment is profitable. Sensitivity analysis help us to prepare for unexpected change, and bank and business use this tool for smart decision making. So you know, in your book you will see a table which is given, right? So let me show you the table first. So now that we understood that what is the role of this best case and worst case scenario, which is all sensitivity, all about the sensitivity, right? So again it is written here. You see that this scenario analysis we're talking about. So this table I'm talking about, right? So how to do the sensitivity analysis? What happened? So what happened in the worst case scenario, right? So you see this pessimistic NPV, expected NPV, optimistic NPV, everything is there. Okay, fine. Okay, so let's talk about this particular graph. What is happening here? So imagine like this, you plan a big project but suddenly cost increase or sales drop. What happened to the profitability? That is exactly what sensitivity analysis help us understand. So you look at this particular table, right? So we see that if investment cost increase, you see if investment cost rise to 48,000, right? So early it was 40,000 and investment cost rise to 48,000, the project NPV falls to how much? You know, it falls to minus 1300 crore or lakh, whatever it is. So that is a loss. But if the sales drop to 30,000, early it was 36,000 and the sales drop to 30,000, right? The project NPV, you know, the project NPV falls to minus 2340 lakh, right? So that is even worse. So this means that if things don't go as planned, the project could turn unprofitable. But the good news is that we can prepare for this risk, right? So this is what it is shown by this particular chart, that what happened to our investment. Instead of 40,000 we have to invest 48,000 in sales. Instead of 36,000 we get sales as 30,000, and you can see what is happening to the NPV, right? Expected NPV was this much, optimistic NPV was this much. You subtract this one, you will get this one, right? So friends, it tells us, our sensitivity analysis tells us how risky or how safe a project is. It tells us which factor affect the project the most, and it also allows business to change a strategy before it is too late. For example, we see that increasing investment could destroy the profit. If we increase the investment, it could destroy the profit. We might try to negotiate better deal with supplier or find cost cutting measure, right? So this is what we can do. So friends, in this case you can see the NPV. In the normal case we are getting 5200, which is the expected NPV, right? In the ideal world the project look profitable, and scenario analysis means what? Best case is that so what can be the best case here? The best case is that that sales are higher, cost is lower. This can be the best case only, right? So best case, let me write down. Best case is that your sales become high, your cost decrease, so obviously your profit will be more. But worst case can be what? Higher investment, lower sale, obviously huge loss, right? So you can see in this table that if the cost increase to 48,000, so worst case will be what? Your investment become high, right? And your sales decreases, so obviously you have a huge loss. So in this case you can see pessimistic, expected, and optimistic. So these are the best cases, right? Our investment is 36,000, which decreases, so investment decreases is the best case. Our sales increases instead of 42. These are the best case. And what are the pessimistic? So pessimistic, suppose cost increase to 48,000, which is investment, right? So NPV drop to -30, -1300, right? If cost decrease to 36,000, so our NPV rise to 8,440 crore. So you can see the sales change now. So if the sales, earlier sales was how much? 36,000. Now if the sales decrease to 30,000, NPV falls to -2340 crore. Right, and if the sales increase to 42,000 from this 36,000, our optimistic NPV become 12,800 crore. And now you can see the variable cost as a percentage of the sale in the next slide, in the next row, right? Variable cost as a percentage of the sale in this row you can see. So now what it says, that high cost means less profit, but even in the worst case NPV stay positive at 680 crore. This is the worst case, right? And now you can see the impact of fixed cost. So if the fixed cost rise to this 2,600 crore, so NPV shrink to 2,940 crore, and if the fixed cost, this is the pessimistic, cost decreases, then it rises to this much. So this tells us which factor matter most, and when the project and where the project is most vulnerable, right? So this is what it tells us. So why sensitivity risk analysis is game changer in risk management? Why this important? Because that it shows how risky or stable a project is. It highlights the most critical area to watch out for. It helps decision maker adjust strategy in advance. For example, if we see that high investment cost are major risk, we can look for cost cutting measure before investing, right? So this is the conclusion, but there are some limitation also. Means we can know which factor is affecting our profit the most, NPV the most, and our main focus should be that factor only, right? Because they are hugely affecting our NPV, right? But there are some limitation also. So while this method is super useful, but limitation is that you can see written here, there are some limitation. Limitation is that, drawback is that it only change one variable at a time. It focus on only one variable. This is one serious limitation. And but in reality multiple factors fluctuate together. In reality this happen. And it depends on how the analyst perceive the risk. So this is influenced by subjective perception. Means how the analyst perceive the risk. This is another factor. How they perceive it. Still, it is a powerful tool that can help business and bank avoid financial disaster. So what we learned from this discussion is that sensitivity analysis help predict financial risk and uncertainty. It highlights the most vulnerable aspect of a project. It allows business to prepare better strategy and to avoid loss. So I hope this sensitivity analysis is clear now, right? Why it is super useful. I hope this is clear. Now let's see what are the steps involved in this sensitivity analysis. So friends, today we are diving into sensitivity analysis, one of the most powerful tool in the risk management. Have you ever wondered how do business predict the risk before making big investment? What will happen if the cost rise or sales drop? What factor can make or break a project success? That is exactly what we are covering today. So by the end of this slide, you will be able to master the sensitivity analysis for your ABFM examination. So what are the steps? So to understand how a project react to the change in the key factor, we follow three simple steps. The first step is to identify the factor, which means we find out which factor impact the project profitability the most. Means which factor will affect the project profitability the most. It could be it could be investment cost. It could be investment cost, or it could be sales, or it could be price per unit. So these can be the different factors which can affect our profitability, or it can be production cost. So investment cost, production cost, sales, price per unit, these are the factors which can affect our business, which is affecting our business the most. That is called key factor, right? Now that is the step number 1. Step number 2, you have to understand the math behind it, develop the mathematical connection. Every financial factor is linked. Higher cost reduce profit, more sale increase revenue. So how they are linked, you can see. So we can create a mathematical connection between these variables to see how they interact. And then if a small change, and then step number 3 is that conduct the sensitivity analysis, which means now we change each factor slightly to check how much it affect the project. So now that we know what are the factor affecting, right, and we have developed the mathematical connection, means how they are related, whether they are directly related, inversely related. Now we change each of these factor, right, we change each factor slightly. So here the key word is change each factor, right, and see how it affect our project. If a small change in one variable causes a huge shift in profit, it is a high risk factor that need extra attention. So in simple word, we say we play with different scenario to see how stable the project really is. Now let me give you an example to see how this step work. So here is an example presented before you. So you can see this example here. So let's apply this step to a company called A Limited, which is analyzing a project, and the key numbers you can see. Initial investment was capital cost, we call it 400 crore, and units sold per year, annual unit sale per year, 5 crore units, 5 crore, this is number of units. So 5 crore units are sold per year, okay, and selling price per unit is rupees 100, variable cost per unit is rupees 50, fixed cost per year is 50 crore, discount rate is 6%, tax rate is nothing, and project duration is 3 years. These data have been given. Now the company need to calculate the net present value to decide if this project is profitable. But what if the things don't go as planned? That is where sensitivity analysis comes into the picture. So what if the thing changes, right? The risk test we are doing now. So now let's conduct the risk test, right? So what we are interested in now is what we call as risk test. So we now test the project by making a small changes into the key factor. So what kind of change we are making? Let's see. So the first change we are doing, what if the sales drop by 2%, right? So what if the sales drop by 2%? That is what we are considering, 2.5% adverse variation each variable. So we will check what will the sales drop by 2%. We will check what if the cost increase by 2%. We will check will the NPV still be positive. We will check can the project still make a profit if the cost increase by 2%. So which factor has the biggest impact on profit? By testing this, we find the most risky factor and prepare the best strategy, right? So I hope this make you concept clear that sensitivity analysis help predict financial risk before investing, and it identify which factor are most crucial, and it help business make a smarter decision, right? So I hope this makes sense to you. Now let's talk about the key highlight of NPV calculation for A Limited. So let's jump back to our A Limited case. So this is where the situation which is given, right? So let me again draw that particular table pie chart, so that you can understand it very easily. So today we are breaking down NPV calculation. What is NPV? What do business rely on it? How do we calculate it step by step? What does this number actually tells us project success? So we know this data, right? So capital was given 400 crore. No need to do that. Annual unit sale is 5 crore. This is what will help us. So annual unit sale is 5 crore unit is sale, and selling price is how much? 100. So it will be multiply both of them. It will be 500 crore, isn't it? It will be how much? 500 crore. Now we divide into two parts. So this part is our variable cost, which is 50 rupees per unit, and how much unit is sale? 5 crore. So 5 crore multiplied by 50 is 250 crore. So our variable cost become 250 crore. What is left? 250 crore is left. Now fixed cost per year, which is 50 crore. So 50 crore is there. What is left? 200 crore is left. So out of this 200 crore, some will go as depreciation. I think depreciation is there, but in this case there is no depreciation. With the depreciation is 0, so whatever is left is our profit before tax, PBT, which is how much? Subtract it, 250 minus 50. So this is 250 minus 50 is 200 crore. So this 200 crore is our net cash inflow per year. I hope this makes sense. And tax rate is also 0, so no tax is there, and also no depreciation is there, right? So our entire profit before tax, profit after tax will be, PAT will be 200 crore. In simple word, company make 200 crore profit. So this is what is represented here. I hope this makes sense to you. 200 crore profit per year after covering the fixed cost. Now step number 2 is our NPV calculation. What is the project worth today? How to go about calculating the NPV, right? So you will see the cash flow, right? What is the cash flow in crore, right? Now we don't just look at the total profit, we check how much is the project worth today, right? So we take all the future cash flow and bring them to today's value using a discount rate, and discount rate is given 6%, right? So that is what we are doing here. You see it in the first year, you know, and it is invested for 3 years. You must know it, note it down, that this project life is 3 years. So for 3 years we are getting 200 crore, right? So let me show you what is happening here. So we are calculating NPV, right? In the first year our investment was how much? This was our investment. So this was how much? 400 crore. So this is negative because this is cash outflow, something is going outside. And in the first year we received 200 crore, in the second year we received 200 crore, in the third year you will receive 200 crore, right? So what we have to do, we have to find the present value of this. So what we will do, we will find the discounting factor or PV factor. We also call it the PV factor. So what will the PV factor for first year? It will nothing, it will be 1. What about the second year? What will be the PV factor for the second year? So how to go about calculating it? It is nothing but, you know, it is nothing but 1 upon, discounting rate is given 6%, right? Just wait a minute. It will be 1 upon 1 plus 0.06 to the power 2 or 1 power 1 for first year. It will be 1 upon 1.06, which will give you 0.943. And in the first year our cash inflow is 200 crore. You just multiply it by 0.943, which is the discounting factor, and this will give you the present value of this 200 crore, which will be how much? 188.60. Similarly, for the second year, what you will do, you will find this, will you apply the formula 1 by 1 plus r whole square, because n is equal to 2 for second year, which is nothing but 1.06 square. And if you calculate it, you will get 0.890. Right? For the third year, it will be 1 upon 1 plus 0.06 cube, which will be 1 upon 1.06 cube. Right? If you calculate it, this will give you 0.840. Multiply them. These are the value which you will be getting. So these are the NPV. So if you add all of them, if you just add all of them, right? So if you add all of them, so you will get how much? And you have to subtract it from 400 crore because this is our cash outflow. So we have done the calculation. I have got 134.60 crore, which is obviously a positive. So what does the NPV tells us? It tells us that our NPV is positive, means the project is profitable. Had the NPV been negative, it would mean the project is a loss making decision. So the A Limited should go with the project, right? Now, so I hope this makes sense. So NPV help business and business, bank and business decide whether a project is worth the investment or not. Right, now let's do the sensitivity analysis considering 2.5% adverse variation in each variable, right? So friends, let me show you a particular table. In this table everything will be clear. So now in this table, let me zoom a little bit so that it become clear to you. This table is taken from your Macmillan book, right? This is how we are doing this sensitivity analysis. So we have 5 different scenarios here. It is all about analyzing how a small change in different business variable impact profitability. Think of it like this: if you change one thing in a business, like the selling price or cost price, how much does it affect the overall profit? So here we have 5 different scenarios here. You can see in this particular case you have 5 different scenarios, right? Let me show you. You can see base case, initial capital cost increase, selling price reduced, variable cost increase, fixed cost increased, and finally, so these are the unit cost reduction. So these are the 5 cases we are taking. Let me show you, highlight it. 1, 2, 3, 4, 5, and this is 6. These are the 5 cases we are taking. So what is the meaning of this base case? So base case means what? You know, it means that this is our starting point where everything looks normal. Then we have the second point where initial capital cost increase, which means what happen if we spend more on setup, right? So it simply means that we spend more. It simply means that we spend more on setup. What will happen? And in this case, what is happening? That what if we have to sell at lower price? So selling price, sell at lower price, that it means sell at lower price. And what it means? Variable cost per unit increase. What if the raw material or production cost go up? Raw material cost, it could go up, production cost can goes up, which is called variable cost increase. And it is fixed cost per unit increase, which means what if the rent, what if the salary, what if the other fixed expense goes up. And last is unit cost per year reduce, which means what if you sell fewer unit than expected. So each of these scenario help us understand how sensitive the business is to the changes, right? Now let's look at the first row, selling price per unit. So in the base case, we assume that we sell each unit for ₹100, right? But in the selling price reduced scenario, that is our first case, right? You can see, let me show you in the selling price. So obviously if we increase the capital cost, it does not affect it, but if the selling price reduced to 97.5, so it will become 97.5, the price dropped to 97.5. Now what about the variable cost per unit? So this is the cost of making 1 unit, right? So in the base case it is 50, right? So everything remain the same, nothing changed, but only this one change. Now if we suppose look at this particular row, variable cost per unit, what will happen to the variable cost per unit in the base case? So this is the cost of making 1 unit, which is the variable cost of making 1 unit, which is rupees 50, and in the variable cost increase case, here is in this case, so it become 51.25, and in rest case it remain the same, it is not affected. Now let's look at the contribution per unit, which means this is the profit made per unit before deducting fixed cost, that is called contribution. So we have not deducted the fixed cost, so before deducting the fixed cost, what is the profit made, right? So just subtract this to 50, subtract this to 47.5, subtract this to 48.5, subtract this to 50, subtract this to 50. So this is called contribution per unit, right? So now let's look at the next one. D is the number of units sold per year, right? Number of units sold per year. Now number of units sold per year, here in this case it will not be affected, but here it will get affected. That is reduced to 4.875 crore, it become 4.875 crore, right? And now what is total contribution? So earlier we calculate contribution per unit. Now we multiply by number of unit to calculate total contribution, which is how much? Just multiply C times D. Let me show you how we are doing it. Just wait a minute. So what we are doing, we are multiplying this 50 with 5, this will give you 250, 50 with 5, 250, 47.5 into 5, 237.5, 48.75 into 5, 243.75, 50 into 5, 250, and 50 into 4.875, 243.75. I hope this makes sense to you. So now we have, instead of calculating per unit, we have calculated total contribution, right? And what is the fixed cost? So tell me. So we have seen that number of units sold per year, right? We have seen. And what is the fixed cost per year? So fixed cost per year get affected in only this particular column, in this particular element. When the fixed cost increase to this one, rest remain the same, right? And what is the net cash inflow? So we have to subtract this fixed cost, so we have subtracted this, we have subtracted this, we have subtracted this, and these are the value which we will get, right, after subtraction, right? Right. So now let's calculate the PV of the net cash flow. PV of the net cash flow. So net cash flow PV. So you have to multiply by the discounting factor, which is 2.673. Multiply all of them, and you will get this PV. Initial capital cost was this much. So just NPV you find it this much. These are the NPV, and percentage change in NPV you can calculate by dividing by the initial NPV. Right. So these are the percentage change you will get. I hope this makes sense to you. So what we see from this discussion is that and highest drop in NPV happen in this particular case, right? We see our project is most affected in this particular case, which is 24.82, right? If we cut selling price, NPV drop by 24.82, right? So what is our discussion? Then NPV is the final thermometer. It tells us whether the investment is worth it or not. If everything is stable, NPV is how much? 134.60 crore. We have just calculated above. But if we cut selling price, the NPV drop by 24.82%. You can see it here. The worst impact of all. So this is how the sensitivity analysis is carried out. So, and if we reduce, so you can see that the reducing the selling price hurt the most. So when selling price drop, total revenue fall. Even a small 2.5 reduction per unit leads to a huge drop in the profit. So business must be very careful about discounting price. It can make or break their success. So sensitivity analysis is all about testing business risk, right? So selling price change has the biggest impact. A small cost change can reduce profit quickly, and that's a wrap. I hope this makes sense to you. So that is the part 1 lecture. In the part 2 lecture we will consider some more project, and we will see how the NPV get affected, right? So I hope you have understood the basic fact regarding sensitivity analysis.